When you deposit $100 at your local bank, something extraordinary happens that most people never think about. That money doesn't just sit there waiting for you. Instead, it becomes the foundation for something that sounds impossible until you understand how it actually works. Your bank takes that $100 and transforms it into nearly $1,000 of new purchasing power in the economy. And they do it completely legally, using a mechanism so fundamental to our financial system that without it, the modern economy would cease to function. This isn't magic. It's not deception. It's the most powerful financial mechanism ever created, and it's been operating right under your nose every single day for decades. Yet most people have no idea how it works, why it exists, or what it means for their financial future. Today, we're going to pull back the curtain on fractional reserve banking and show you exactly how banks create money from what appears to be nothing. But first, let me destroy a myth that probably shaped how you think about banking. You likely believe that when you deposit money, the bank stores it safely in a vault, and when someone else wants a loan, the bank lends out your deposit. That's not what happens. In fact, that's not even close to what happens. The reality is far more sophisticated, far more powerful, and far more consequential than most people realize. Here's what actually occurs the moment you make that deposit. Your bank keeps a small fraction of your money as reserves, typically around 10%. The remaining $90 becomes available for lending. But here's where it gets interesting. When the bank makes a loan with that $90, they don't hand over your physical cash. Instead, they create a brand new deposit in the borrower's account. They literally type numbers into a computer, and new money springs into existence. Think about what just happened. Your original $100 still exists in your account. You can withdraw it, spend it, or transfer it whenever you want. But now there's also $90 in someone else's account that didn't exist before the loan was made. The total money supply just increased from $100 to $190. And this is just the beginning. The borrower takes that newly created $90 and spends it, perhaps paying a contractor who deposits it in their own bank. That bank now has $90 in new deposits. Following percent reserve requirement, the same 10 keep. They $9 and lend out $81 by creating another new deposit. The money supply grows again. Now we have your original 100, plus the first 90, plus this new 81, bringing the total to $271. This process continues through what economists call the money multiplier effect. Each round of lending creates smaller amounts, but the cumulative impact is staggering. By the time this cycle runs its course, your original $100 deposit has supported the creation of nearly $1,000 in total money supply. $900 appeared in the economy that didn't exist before you walked into that bank. The Bank of England, one of the world's most respected central banks, confirmed this reality in a groundbreaking report. They stated clearly that commercial banks create money in the form of bank deposits by making new loans. When a bank approves your mortgage, they don't count out cash from a vault. They credit your account with a deposit equal to your loan amount. At that precise moment, new money enters the world. This revelation challenges everything most people believe about how money works. We think of money as a finite resource, like gold or oil, that gets moved around the economy. But the truth is that most money in circulation is created digitally through this lending process. In fact, studies show that 97% of all money exists as bank deposits, while only 3% consists of physical cash and coins. Now you might be wondering why this system exists at all. Why do we allow banks to create money from nothing? The answer lies in understanding what this mechanism accomplishes for economic growth and development. Without fractional reserve banking, the money supply would be severely limited. There wouldn't be enough currency in circulation to support business expansion, home purchases, or the countless transactions that drive modern commerce. But this power to create money comes with profound implications that extend far beyond individual bank accounts. It affects inflation, economic cycles, and the distribution of wealth throughout society. It determines who has access to capital and who doesn't. It influences everything from housing prices to business formation to government fiscal policy. The mechanics we've described so far represent the traditional textbook explanation of money creation. But the modern reality is even more fascinating and complex than this simplified model suggests. Banks don't wait for deposits to make loans. They don't physically move money around. And the constraints on money creation aren't quite what you might expect. In the digital age, money creation has become even more streamlined and immediate than the traditional model suggests. When you apply for a loan today, the bank doesn't wait to see if they have enough deposits on hand. They don't shuffle money from one account to another. Instead, they evaluate your creditworthiness, and if approved, they simply update their computer systems. Your loan amount appears in your account instantly, created through what some economists call keyboard money, new purchasing power generated with a few keystrokes. This process reveals something profound about the nature of modern money itself. The numbers you see when you check your bank balance aren't backed by gold sitting in a vault or even by physical currency. They're digital entries in a computer system, backed by your promise to repay the loan and the bank's confidence in that promise. Your mortgage, your car loan, your business credit line, all of it represents newly created money that entered circulation the moment your application was approved. But there's a crucial element that keeps this system from spinning out of control. Banks face regulatory requirements that limit how much money they can create. These capital requirements mean that for every dollar they lend into existence, they must maintain certain reserves and meet specific financial ratios. Central banks also influence this process by setting interest rates and reserve requirements, effectively controlling how much new money enters the economy. The implications of this system extend into every corner of economic life. When banks create more money through lending, they increase the total purchasing power in the economy. More money chasing the same goods and services typically leads to higher prices. This is why understanding money creation helps explain inflation patterns, housing booms, and economic cycles that might otherwise seem random or mysterious. Consider what happens during an economic expansion. Banks become more confident about lending, so they create more money through loans. This new money flows into businesses, real estate, and consumer spending, driving up prices and economic activity. But when confidence wavers, banks tighten lending standards, creating less new money. The reduced money creation can slow economic growth and even contribute to recessions. This dynamic also explains why access to credit matters so much for wealth building. Those who can qualify for loans effectively gain access to newly created purchasing power, allowing them to buy homes, start businesses, or make investments before prices rise. Meanwhile, those without access to credit must rely on existing money, often watching asset prices climb beyond their reach as new money flows into markets. The geographic distribution of money creation also shapes economic development. Banks tend to create more money in areas where they see profitable lending opportunities. Thriving metropolitan areas with growing businesses and rising property values attract more lending activity, leading to more money creation and further economic growth. Rural or declining areas may see less credit creation, potentially limiting money. They're shutates why banking crises can be so devastating. When banks contract as loans are paid, fail, or drastically reduce lending, they replace them. This explains why bank runs not just withholding existing of new money. The next time you walk into a bank, you'll see it with completely different eyes. What looks like a simple transaction is actually the engine that powers our entire economy. Your deposit doesn't just store value, it multiplies it, creating new purchasing power that ripples through every market, every transaction, every financial decision around you. Understanding this mechanism isn't just fascinating. It's essential for anyone who wants to truly comprehend how money moves through the world. This content is for educational purposes only and does not constitute financial, legal, or investment advice. If this opened your eyes to how the financial system really works, hit subscribe. There's so much more to discover.